Hello and welcome to the Business Standards Morning Show. I'm Kanishka Gupta and let's have a look at the stories for the day.
What the world needs now is people who see healthcare a little bit differently. Because seeing a healthier world isn't far in the future. We're building it now. GE, building a world that works.
Several fund managers have been under the SEBI radar for quite some time now over their alleged role in markets norms violations, including the dubious practice of front running. And the markets regulator is said to have expedited its probe after revelations at Axis Mutual Fund last week, where two fund managers were stripped of all the responsibilities over suspicion that they too were involved in front running. So is it just a stray incident or yet another tip of the looming iceberg? Will it dent the investors' confidence? And what should the regulator do to check it? Know all this and more in our next report.
India's seventh biggest mutual fund house, Axis Mutual Fund, suspended two fund managers last Friday, pending the completion of an investigation it has been conducting over the last 2 months. While the nature of the irregularities was not revealed, media reports say the fund managers were allegedly involved in front-running the trades of the mutual fund on their personal accounts. Front-running is a dubious market practice in which an insider who is privy to a big future transaction by a fund or a big investor takes advantage of the information. Large orders usually move a stock's price, and the insider buys shares just before the big order hits the market and sells them once the price moves up. It can adversely affect the investor in the fund and is banned in India. Several cases of front-running have come to the fore earlier too. Last year, SEBI had taken action against 3 dealers of Reliance Securities for front-running the trades of Tata Absolute Return Fund, an alternative investment fund. In 2006-07, the markets regulator found that an equity dealer at HDFC Mutual Fund was passing on trade information to an outsider entity. The suspended Axis Mutual Fund managers allegedly informed brokers about stocks that they intended to buy in large quantities. The modus operandi was to benefit from a potential movement in stocks due to large orders from the fund house. The fund house has now reassigned their responsibilities to other fund managers in 7 schemes which have combined assets under management of over 7,700 crore rupees. A financial daily reported that a preliminary investigation pointed to front-running in as many as 9 stocks that led to ill-gotten gains to the tune of 170 crore rupees. Business Standard on Monday reported that SEBI is examining allegations of front-running and other irregularities against a number of domestic fund managers. Developments at Axis Mutual Fund have reportedly prompted SEBI to speed up the probe to ensure that there is no drop in confidence in the 39 trillion rupee domestic mutual fund industry. Axis Mutual Fund's MD and CEO Chandresh Nigam tried to play it down, saying the recent developments do not impact the portfolios held by any of the schemes of Axis Mutual Fund. In a letter to investors, he said the fund house has not put any restrictions on redemptions. The fund house manages assets worth 2.59 trillion rupees. India has more than 2.4 crore mutual fund investors with 10.3 crore folios. Should they worry over the recent events?
Whatever is basically happening on the what we call front running side is separate than the fund management side of the activity. The fund manager is producing the performance in the fund. Even if there is a front running which may have taken place at the dealer level, at the execution level, still the performance of the fund has been there for the investors. The investors should be judging the investment that they have done should be based on the performance of the fund. I think there are many checks and balances, I think, at every stage as far as the regulatory aspect goes. And I think they will further do, I think, whatever is necessary in this case, I think, to prevent many such kind of thing happening in future. This industry has been having this problem not only in India but across the globe. In fact, I think for the pre-transaction related checks and balances, I think the system will have to be, I think, even further simplified instead of making it complicated. That is what I would like to believe. Any solution that you arrive at, I think, has to be a preventive solution and not reactive solution.
Sriram Subramanian, founder and MD of Ingovern Research Services, says that retail investors need not react in a knee-jerk manner, but should demand more transparency from the fund house.
Prima facie, it doesn't seem to be a systemic issue within Axis Mutual Fund. But that being said, Axis Mutual Fund hasn't come clean on what was the reason why the investigation was started or set up 2 months ago, and why was the need for Axis Mutual Fund to go about doing the investigation on its fund managers and eventually take them off. Two is, and this observation was also made by external observers, who pointed out that all the funds and the fund managers have changed, and then there were various rumors that started. So it was not forthcoming from Axis Mutual Fund or from SEBI for that matter. So that is something to worry about. So at the end of the day, I don't think retail owners need to be very worried, but they should monitor it very closely. And if anything, they should write to the fund managers, the CEO, and demand an explanation. Axis Mutual Fund has unfortunately not put out a white paper or a detailed explanation on why they needed to investigate in the first place. What was the actual non-compliance? Was it front-running? What was the extent of the front-running? And what were the findings of their internal investigation? And two is SEBI also is not yet come out saying that they are investigating this matter. And if they Axis Mutual Fund is to retain the trust of these investors, is to continue to hold whatever reputation they have had in the past, it should come out with a white paper on this entire issue.
Experts say that the Axis Mutual Fund episode should be treated as an isolated incident and retail investors should not be too worried. However, in order for the mutual fund industry to hold on to the trust it has built over decades, transparency from the regulator as well as fund houses is paramount. SEBI should also take stringent steps against frontrunners. Barring erring entities from markets for a short period may not be enough.
सब अच्छी दिख रही हैं यार, कौन सी खरीदूं? ये तो वही बात हुई, 4000 शेयर्स लिस्टेड है, कौन सा लूं? वो तो सबसे आसान है। तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा पर है 4000 स्टॉक्स की रिसर्च, टेक्निकल टूल्स और इन्वेस्टमेंट आइडियाज। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Experts believe that a few such incidents may not shake the investors' confidence in the mutual fund industry. Let us move on to India's booming export industry. For some time now, exports have been a bright spot for the Indian economy, which has recently emerged from the shadow of pandemic. It reached the $400 billion export mark in FY22, way before the end of fiscal year. However, despite such an achievement, the government looks circumspect. The Commerce Ministry has not projected any fresh exports target for FY23. Is it due to the uncertainty surrounding the world trade? And how can India sustain its export growth momentum? Let's find out.
It has been a season of records for the Indian export sector. India comfortably crossed the $400 billion export target in FY22 by $20 billion. Previously, outbound shipments had touched a record of $330.07 billion in 2018-19. And amid high commodity prices and the ongoing Russia-Ukraine conflict, India's merchandise exports swelled by 24.2% in April to $38.2 billion, the third highest level ever. Before this, the preceding month had seen record exports of $42.2 billion. The growth seen in exports in April was partly a function of commodity prices. Consider that petroleum product exports more than doubled, with a 113% increase compared to April 2021. Meanwhile, chemicals increased by 27%. But as a Business Standard editorial highlighted, there were also indications that the increase in exports of electronics goods had possibly become sustainable. In fact, exports of electronics goods surged by 64% year on year. Let us also consider the key drivers for FY22's exports performance. Exports of engineering goods jumped 32% in the first 11 months of FY22 compared to the previous financial year. It was the biggest export item. However, in April, exports of engineering goods registered subpar growth at 15.4%. Quoted in a previous Business Standard report, Engineering Export Promotion Council Chairman Mahesh Desai had said that high logistics cost and unprecedented increases in raw material costs had been hurting engineering goods exports. Although he saw the growth momentum seen in FY22 continuing. According to Desai, the trade deals with the UAE and Australia would give a boost to the sector, and the proposed free trade pacts with the UK and Canada would further add to this positive momentum. This brings us to two deciding factors that will impact India's exports growth going forward. First, how much of this growth can be attributed to the medium-term effects of higher commodity prices, and how much to the long-term effects of a more export-focused finished goods sector. Second, the impact of recent and future trade deals.
My assessment is definitely there is a price effect, but on the other side, I see the quantity effect as well. The commodities like petroleum products, if you see, definitely input prices have increased, but quantity wise, I definitely see a rise in this. Specifically in the chemical sector, if you see, the organic chemicals are doing very well. Some of the miscellaneous chemicals is also doing well in this sector. Apart from that, the iron and steel, cereals, electrical machinery, sugar confectionaries, plastics, pharma is doing great job with respect to the increment if we compare looking at the previous years. Look at the current India's FTA strategy. You will definitely find out a lot of commodities being ratified with UAE and Australia, which are very labor intensive. And definitely we will get a lot of scope for industries like textile, industries like leather, rubber, or gems and jewelry. These commodities will get a boost. And apart from the FTA strategy, I definitely see another important factor is the PLI scheme, which has been introduced, and government is persistently checking, monitoring, and screening the amount of exports and imports that we are doing under the labor intensive commodities, because they have a pressure to generate the employment and growth through these intensive sectors. Be enormous in future. So I definitely feel that current FTAs are are very different in terms of time. They are very time bound. They are looking at the policies. They are actually debating on the issues which are more contentious issues, and they're looking at the policies where they wanted to look at the industries from the holistic overview. In the sense that they are more of offensive in their interest rather than defensive. They know that which sectors to be exported, they know which sectors to be imported. They are very clear what needs to be offered and what needs to be taken. So I think in this case, the current FTAs that we have signed with UAE and Australia, it shows a very different picture of India as compared to the previous negotiations that we had. In this, we are looking at more comprehensive FTAs that India has signed, where India is looking at some of the new issues which they wanted to explore. They wanted to open the markets for them. And on the other side, in the coming FTAs with developed nations, India wants to give the signals to the world that we are ready for not only for the developing nations, but we are ready for the developed nations as well.
Recent developments also indicate challenges going ahead. The last week saw central banks across India, the United States, the United Kingdom, and Australia commence actions to fight inflation. This has translated into an increase in benchmark interest rates and also the withdrawal of excess liquidity, which had been injected during the past 2 years to counter COVID-19's economic impact. These steps are likely to result in lower global trade and economic growth. Then there are the disruptions in global shipping and supply chains due to the strict lockdowns in China and the Russia-Ukraine war. Amid all this, there are various measures that the government can take to secure exports growth. First, ensuring that competitiveness increases throughout the exporting sector, which will require an upgrade of both physical and soft trading infrastructure. Second, it must speed up new trade agreements that lower tariffs all around and enhance market access. On a related note, it will also have to leave behind the practice of raising tariffs to protect domestic industry. Finally, exporters will be helped by the weakening of the rupee against the dollar. The RBI should play a supportive role in this regard.
In future also, I feel the kind of targets which is being set by the ministry, or would be, I mean to say they would be setting any targets, though they are setting the lot of targets for Export Promotion Council, respective ministries, to meet those targets. But yes, they are a little flexible also about these targets, looking at the current situations, and we don't know what could be the emerging situations in the future.
India's merchandise exports to GDP ratio has been on a declining trend. While this ratio will show an improvement in FY22, it will still be nowhere near the record seen more than a decade ago. It remains to be seen whether the government can reverse this trend.
यार
मत पूछ यार, फिर से स्टॉक्स में फंस गया।
तो स्टॉक्स के साथ बॉन्ड्स, इंश्योरेंस, गोल्ड में बैलेंस कर।
इसमें बहुत तामझाम है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा है ऑल इन वन अकाउंट। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है। Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
India's plan to boost its wheat export may be derailed due to the ongoing heat wave. But the extreme weather bodes well for some. Stocks of power companies usually rise in tandem with the soaring mercury. The sector is grappling with low coal inventories. So will the situation get worse amid record high power demands? And how should investors bet on it?
India's power consumption spiked to an all-time high of 133 billion units in April amid the rise in mercury level in the country. According to India's Power Ministry, the country's electricity demand is expected to rise to 220 gigawatts in the next 2 months as the Met Department forecasts above normal maximum temperatures in West Central, Northwest, North and Northeastern regions. It's not surprising then that power-related stocks have been the favorable destinations with investors this year. The stock prices of power sector companies, including power generation and power distribution, have done materially better than the benchmark indices. Shares of companies like Adani Power, Tata Power, Power Grid, and NTPC have surged from 2 to 175% so far this year. In comparison, the S&P BSE Power Index has gained over 35%, while the benchmark S&P BSE Sensex Index declined over 7% during the same period. However, despite the rally, analysts remain bullish on related stocks and expect power utilities to benefit from the spread between rising power demand and acute energy crisis.
Many things are likely to change. Power tariff, there will be a hike. Now, for Tata Power, they have a coal supply. From Indonesia, they will get it. So, and they are not operating at full capacity. And they have different other businesses also. NTPC will be the major beneficiary of the crisis which we are facing. Whatever crisis we are facing, NTPC will be the major beneficiary. So, we are positive on NTPC, Tata Power, to an extent Torrent Power. Beyond that, we will not like to look at it. demand is likely to stay elevated only till June at least. And Coal India will be the beneficiary, but Coal India has a problem also. If you look at their expenses, now employee cost is almost 44%. No, so a company where employee cost is that high, it will be very difficult for them to make higher margin.
That said, some industrial units in states like Uttar Pradesh, Haryana, Delhi, Punjab, Rajasthan, Tamil Nadu are reportedly considering production cuts amid power outages. Moreover, the dwindling inventory of coal, which contributes nearly 80% of India's power generation, has also failed to keep pace with the elevated energy demand. Though state-owned Coal India has ramped up supplies to power plants by 6.7 metric tons from a year ago, analysts remain uncertain whether the increased output would cater to both international as well as domestic demand. Analysts assume Coal India to benefit from the higher volume growth due to accelerated dispatches of coal to power plants at domestic front.
We have already seen a peak power demand of almost 201 gigawatt recently. And this bodes well for higher coal demand in the country, as 70% of India's power generation is done through thermal coal plants. Here we see Coal India as the clear beneficiary, as this higher coal demand would boost its overall volume growth. Its dispatches to the power sector has seen a sharp uptick in the month of April, and the volumes are up by 16% YOY. From the power generation company's perspective, we see some impact of fixed cost under recoveries due to coal shortages, as it will lower the plant availability factor for thermal power plants. Having said that, we are of the firm view that overall earnings outlook for power generation companies remain intact, as they work on the regulated equity model, which assures fixed ROE on power generation. We prefer NTPC, Power Grid, Tata Power in the sector, and have buy rating on these names.
Meanwhile, high prices of imported coal due to geopolitical uncertainties are expected to send power tariffs through the roof. In March, merchant power prices surged to 8.2 rupees per unit as against an average of 4 rupees per unit. According to a report by CRISIL Ratings, merchant tariffs could remain over 6 rupees per unit this quarter, the highest in the past 5 fiscal. Overall, with production reviving to pre-pandemic levels, the need for clean power supply also gives immense scope of growth for the power sector. Therefore, analysts expect the momentum in power stocks has more steam left. Lastly, investors saw markets shut on a choppy note as frontline indices Nifty 50 and Sensex closed 0.67% lower each. However, primary markets were abuzz as the mega LIC IPO was subscribed over 2.91 times on the final day. As regards today, investors will watch out for earnings report card of Asian Paints, Cipla, Vodafone Idea and Gujarat Gas.
अब क्या किया?
शेयर्स में ट्रेडिंग।
तुम्हें 5 पैसा नहीं पता?
ओए, अब तो सबको पता है। 5 पैसा पर मिलते हैं रिसर्च टूल्स, पोर्टफोलियो एनालिटिक्स और इन्वेस्टमेंट आइडियाज भी। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
After the power sector stocks, let us see how the government is using technology to usher in transparency. It is now planning to roll out e-passport soon. What is it and how different will it be from our regular passports? Let us find out in next report.
During her Union Budget speech on February 1st, Finance Minister Nirmala Sitharaman announced the government's plan on the issuance of e-passports embedded with an electronic chip in order to enhance convenience for citizens in their overseas travel. According to the proposal, the e-passport will be a combination of paper and electronic passport with a radio frequency identification or RFID chip. An antenna will be embedded as an inlay in the back cover. The passport's critical information will be stored in the chip and printed on the data page. The characteristics of the e-passport are specified by the International Civil Aviation Organization, an agency of the United Nations. The government clarified that data of the citizens obtained for e-passport will be used only for the purposes of issuance of the passport and related services. There will not be any secondary use of the data, thereby safeguarding privacy concerns. Further transaction processes are authenticated by a digital certificate and are cryptographically signed. Once captured, the data is stored in a secured industry-standard database. The Security Operations Center will perform relevant database security-related controls around the clock. The government is currently testing sample e-passports with the full-scale manufacture and issuance set to commence following completion of the technical ecosystem and infrastructure. The facility to issue e-passports will be made available in phases at all 36 passport offices across the country. Tata Consultancy Services has reportedly backed the contract for delivering e-passports. The deal is an addition to the second phase of implementing the Passport Seva program, which the company got from the External Affairs Ministry. While the government will source the hardware chips, TCS will be responsible for their encoding. The government has entrusted National Informatics Center with the technical responsibilities. The e-passports will be procured by the India Security Press in Maharashtra's Nashik, which has issued letters of intent for the procurement of 4.5 crore ICAO-compliant electronic chips. Interestingly, the government issued India's first e-passport with biometric details to former President Pratibha Patil in 2008. At the request of the Ministry of External Affairs, the National Informatics Center had conducted a pilot project for the issuance of e-passports then. About 20,000 e-passports for diplomats and officials have been issued. E-passports enhance the security of passports, eliminate duplication, eliminate data tampering, and will be used by border control authorities for monitoring the entry and exit of passengers. Minister of State for External Affairs V. Muralidharan recently said that any tampering of the chip will be identified by the system, resulting in the failure of the passport authentication. He said that in addition to providing protection against fraudulent practices, the e-passport with its advanced security features will substantially upgrade existing passports and services to the citizens.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Activists around the world have been opposing the e-passports or the biometric passports. They allege that there is a lack of information about exactly what the passport chip contain and whether they affect civil liberties. That's all for today. We will be back with more news and analysis on our next episode. Stay tuned and thank you for watching. If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.